everyone. As it turns out, I had a lot to say to introduce you to our section on the different types of business entities and to introduce you to sole proprietorships. So I just decided to stop that video there and then actually create a new PowerPoint presentation with just the slides on a general partnership. So as we said during the first PowerPoint presentation, this is the unit where we are going to walk through the different types of business entities and talk about the different characteristics. And the ones that I'm most interested in, as I mentioned, is how those business entities are able to begin. Are they complicated to start up? And do they require state paperwork? How those businesses are managed, how they are taxed, how the owners are exposed to liabilities, and in general, how the businesses are run. And then we will see that what the different characteristics of all these business entities are, and also be able to see the advantage and disadvantages for them. So we talked about sole proprietorships, and if it's been a little while since you listened to the first video, make sure you remind yourself of the characteristics of sole proprietorship. Because one of the things that we mentioned is, if you take on a partner, if you are a tutor, for example, or I can use another example of, let's say I start a lawn mowing business. I own a lawnmower, I own some hedge trimmers, and I think I'm going to start a business mowing lawns. If I'm in business for myself, then I am a sole proprietor. If it's just me, I am the one sole owner. But let's say I am doing really well with my tutoring business and my friend Bob over here, he wants to join my tutoring business as well because I have so much, I can't fit all my appointments in. And so I will tutor some people and Bob will tutor some people. And I want to call Bob my partner. Well, the second an owner of a sole proprietorship takes on a partner, then that person is no longer a sole proprietor, but a partnership. And we call the name of the partnership, we call it a general partnership. Now, in your book, there's also a discussion of other types of partnerships. There's limited partnerships and limited liability partnerships. So do take a look at the different definitions of those entities, but I'm not going to spend as much time, or really any time, discussing those. As I mentioned, these PowerPoints are really just supposed to hit the highlights of what we're talking about. But with a general partnership, a really easy way to think about a general partnership, it is that it is a sole proprietorship, but with more than one owner. It's a sole proprietorship, but with more than one owner. How many partners can be in a general partnership? It's unlimited. The law doesn't say you have to have 5 partners or 10 partners. You just have to have at least 2, and you are a general partnership. Each partner is called a general partner. Again, take a look at your book to compare the differences between a general partnership and a limited partnership, because in those partnerships, the partners do have different names. But in a general partnership, both partners are called a general partner. Now, I've already said that the general partnership is exactly like a sole proprietorship, except that it's more people. And that's true for a lot of the other characteristics. For example, how do you form a general partnership? It's also really easy to form a general partnership. The state of Massachusetts and the other 50 states don't require the filing of special paperwork to designate yourself as a general partnership. Really, you just need 2 people to get together and say, let's be business partners, and you have formed a general partnership. Just like if you woke up in the morning one day and said, I would like to run my own business, and you operate yourself as a sole proprietorship. So it's pretty easy to form a general partnership. Now, you might be asking yourself, shouldn't the partners write something down? Wouldn't it be better if the partners had an agreement with each other that was in writing? And that's definitely true. But what's interesting is the law does not require the partners to have a written partnership agreement. However, it is advisable. As your lawyer not giving you legal advice, I would say that it would also be advisable to have a partnership agreement, but it is not required. What could go in that partnership agreement? Really, anything that's of importance to the partners. Maybe you want to talk about the different tasks each one of you is undertaking, how many hours you're going to work. That could all be put down in a partnership agreement. Even something as simple as how often do you want to meet to discuss how the business is going, plans, what we're doing, daily, monthly, weekly. that could all be put down in a partnership agreement. What else is similar to a sole proprietorship? Oh, actually, before I move on to the next slide, the other characteristics that are similar to a sole proprietorship is both taxation and liabilities. Even though this is out of order from my slides, I'm actually going to go ahead to the last slide. So if you have this printed out, you can actually look at the last slide, because I want to talk about liabilities in a general partnership, because this is what I was referring to in my other slide in terms of the shield. So take a look at this slide here and see how I've divided it out. Pause the video if you'd like. I often, in addition to like a tutoring business and a landscaping business, the other business I really like to hypothesize about is running my own bakery. My younger son really loves to bake, and we often talk about what it would be like if he ran his own bakery. His name is not Bob, by the way. But let's imagine we have Sugarman's Bakery right there in the middle, and Hallie and Bob form a general partnership. Remember what we said about the concept of liabilities and having that protection over your own personal assets? Imagine that I'm over here, I'm Hallie to the left, and I have my own personal assets. I have a car, I have a house, and I have $10,000 sitting in a bank account, and I have a computer. Those are my personal assets. They don't belong to the business. What about Bob? He also has his own personal assets. He's much more wealthy than me. He has a car and a house, and we can say that he has $1 million in savings. So that's Bob, and that's his money and assets, and that's me and my money and assets. And then we form a partnership. If our partnership were to get sued, we have no shield or protection over those personal assets. We are all one and the same, much like the sole proprietor. That means that all the money that we put into the business and our own personal money is at risk for satisfying a judgment in a civil lawsuit. Again, as we move into limited liability company and corporation, we will see what kind of protections the owners have over their assets. Keep an eye in this slide. You're going to see a version of it again when we compare the two. But I just wanted to kind of skip ahead in our slides here to talk about how sole proprietors and general partners are the same in terms of no liability shield over the personal assets. The other way they are the same is in taxation. Remember, with the sole proprietorship, we said that individuals as a sole proprietor are taxed on their own personal tax return. The business does not pay its own taxes. That is true with general partnerships as well. Let me skip ahead, and actually I'll go back, and I want to go over some of the slides. I wanted to talk about this concept called partnership by estoppel. So pause the video again if you need to kind of reorient yourself. But if you go back a few minutes, we were talking about how a partnership is formed and how partners agree to be partners. You don't have to tie someone down and force them and say, will you be my partner? If two people just agree that they're going to share business together, then they're partners. And this is really important, and business people, like you guys as individuals, need to be aware of this. Because the law does not give you like a special process that you have to go through to become partners, if two individuals act like they are partners, even if they don't say or shake their hands and say, we will be partners, the law is going to treat them as partners. So if you act like you're partners, or you introduce, let's say, your friend as your business partner, and then someone else relies on that and really thinks that you are partners, then you're responsible as partners. And this is really important because partners, because there's now two or more individuals, share profits, but they also share losses. So let me just repeat that. When you're a sole proprietor, all the money that you earn, that's yours to keep, right? You're the sole owner. But if you are a partner, then you share your profits with the partner, but you also share losses. So if you represent to other people that you and another person are partners, and someone suffers a harm and wants to sue you, you're responsible as partners, even if you didn't say to each other, yes, we're going to be partners. So don't act like you're partners if you don't really intend to be partners. I'll let you pause the video and read this example because I don't want to take the video's time to read it to you. But take a look and see what you think. You can argue it either way. But if other individuals think that you're a partner with another individual, then the law will treat you as partners and force you to share in liabilities and losses, even if you didn't have some magic shaking of hands about it. Partnership by estoppel is really important. Estoppel is also one of those really cool legal words that you can use to impress your friends and family. It means you're stopped from acting a certain way. It's a fancy way of saying stopped. Let me just repeat this here at this point here about sharing profits and losses. If Tim and Bob each own 50% of a Bedford landscaping company and the money earns $50,000 in 2019, the profits are split evenly. But one really interesting thing about sharing profits in a partnership is the partners can decide to divide that that pie of ownership in different ways. So we could decide that we wanted to be 50-50 partners, and you own 50%, I own 50%, in which case we will share the profits evenly. But if I have $1 million to bring to the business and you only have $200,000, that's okay. We can decide to share the profits differently. I can own 80% of the pie and you can own 20%. So that means if profits are taken in, I'll get 80% of the profits, but you'll only get 20%. That's part of our development of the partnership agreement that can be up to us. It's very flexible. Now, of course, the downside is that we share in the losses, as I just remembered. So there's a lot of important pieces here to sharing of the losses. Number one is that, of course, we have that unlimited liability. We don't have a shield. All of our personal assets are at risk. The other point about sharing liabilities goes like this. Let's say it's a landscaping company and we are 50-50 partners or 60-40, doesn't really matter. But let's say I know nothing about landscaping, but I'm a really good office manager and you are an expert at landscaping. So we join forces and we decide to create a partnership, and we decide that I will handle all of the office. I will do all the appointments, the billing, the invoices. I will take care of everything in the front office, and you will go out and mow lawns and take care of landscaping. And all the money that comes in, we will split it 50-50. That sounds great, right? Because we're each bringing our skill set. But let's say one day while you're out mowing, you mow over somebody's prized rose bushes and destroy them. You mow over some rocks and they run into someone's house and break the windows. And now the homeowner wants to sue our business. Of course she should. Can I, who've been sitting in the front office all day, say, no, sorry, you can only sue my partner because I was in the front office. I'm not responsible for those liabilities. Can I say that? So this is really interesting. The way partnership law works is something called joint and several liability. A partner is liable for any injury that another partner or employee caused while conducting that partnership business. So that means that even if I was in the office all day taking care of making appointments and billing and invoices, and you are out there in the field all day and you're the one that actually caused the problem, not me, I am still liable because we are partners. Remember, we share profits, but we also share losses. And the way that we share losses, the two important points are that there is unlimited liability, there's no shield, and that we are equally liable for the actions taken by our co-partners. That's a really important principle. Remember, you're no longer responsible for just yourself. That would be a sole proprietor. With a partnership, you get the benefit of having somebody to help you manage and run the business, but you also have the risk involved with running a business with another person. All right, well, I've said a lot in this PowerPoint, but I hope you took away the important principles of partnerships in terms of how they are formed, how they are taxed, how they are managed, and also the part about sharing profits and losses, joint and several liability, unlimited liability, and something called partnership by estoppel. That was a lot packed into 15 minutes, so I apologize if it seemed really dense, but those are the big takeaways. All right, that's the end of this PowerPoint. As we move forward, we'll talk about the other types of business entities next week.